Ladies and gentlemen, good day and welcome to the earnings conference call in respect of Inter Alia, the financial results for the financial year and quarter ended on 31st March 2025, hosted by GE Power India Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Mr. Puneet Bhatla, Managing Director of GE Power India Limited. Thank you, and over to you, sir.
Thank you. Good evening, dear investors. A very good evening to all of you. Thank you for joining today's call, where we will discuss our performance for the fourth quarter and the full year ended March 2025. We believe you all have reviewed our results and investor presentations, which are available on our website as well as on all the stock exchanges. I am joined today by our CFO, Mr. Ashish Ghai, to update you on our performance across the business and to address any queries you may have. Before we discuss the quarterly and the annual performance, we would like to briefly touch upon the broader economic context. The global economy today stands at a critical juncture. In the last year, we have witnessed a series of unprecedented shocks that have tested the resilience of economies across the world. Through 2024, global growth remained stable but modest and below potential. Now we are seeing a shift in the landscape. The introduction of new tariff measures by US and the subsequent responses from major trading partners have added fresh layers of uncertainty. Trade policies are evolving rapidly, and the wide range of outcomes remains possible. In the face of ongoing structural shifts, heightened uncertainty, and persistently weak growth, the path forward must focus on restoring confidence, strengthening stability, and addressing global imbalances. Above all, we need policies that can sustainably lift growth and support long-term economic resilience. Looking ahead, while global growth is expected to moderate slightly from an estimated 3.3% in 2024 to 2.8% in 2025, it is projected to regain momentum, rising to 3% in 2026, reflecting continued resilience and the potential for the steady recovery in the medium term. This represents a cumulative downgrade of 0.8 percentage point compared to January 2025 World Economic Outlook projections of 3.3% for both the years. Though the projection remains below the historical average of 3.7% seen during 2000-2019, the revisions are broad-based across countries and reflect direct and indirect effects on the new trade measures, heightened uncertainty, and deteriorating sentiments. But on the positive side, the global inflation outlook continues to improve. Headline inflation is forecast to ease to 4.3% in 2025 and further to 3.6% in 2026, reflecting a progress towards stabilization, even if full normalization to pre-pandemic levels is still underway. Within global context, India's economy continues to demonstrate robust growth. India's real GDP rate is projected 6.2% in 2025 and 6.3% in 2026. The growth outlook for India is described as relatively more stable compared to some economies, supported by private consumption, particularly from the rural sector. In the month of March 2025, India's power consumption increased by nearly 7% to 148.48 billion units as compared to the previous year. The highest supply in a day also rose from 221.68 gigawatt in March 2024 to 235.22 gigawatt in March 2025. Peak power demand is expected to touch 277 gigawatt in summer of 2025. Coal demand in India continues to rise steadily, reaffirming its position as world's second largest coal consumer. In 2024 alone, demand grew by about 5.5% or nearly 40 million tons marking a new all-time high record. This growth was driven by strong economic activity, which boosted coal use both in power as well as industry sector. The power sector, accounting for nearly three-quarters of the total coal demand, saw coal-based generation rise by about 5% in line with the growing electricity needs. A major factor behind this rise was intense and the prolonged heat waves in the month of May and June, which significantly pushed up the power demand. That being said, this rapid growth came with the environmental cost. India's energy-related carbon dioxide emission rose by 3.5% in 2024, the highest among major economies, highlighting the pressing need for stronger emission control measures. Now coming down to JEPIL, as we enter the new year, we are pleased to report that business strategy we outlined earlier focused on new growth areas and reducing exposures to working capital. Long gestation projects is starting to deliver results with losses narrowing and revenue streams getting stabilized. Coming to our business performance, I am pleased to report that we have had yet another strong quarter, showing signs that our efforts are moving in the right direction. Operational excellence resulted in 12 points increase on asphalt margins in the core deal. As many of you would be aware, in the first half of the year, we took some bold, decisive steps to create lasting value for our shareholders. This included the strategic sale of our hydro business and gas business. As a result, the standalone net worth of our company stands today at 233 crores versus 57 crores as on March 31st, 2024. As we work towards stabilizing our business and building a strong order book across four key growth areas, core services, upgrade services, FGDs, and our Durgapur operation, it becomes all more important for us to enhance shareholder value and attract greater investors' interest. I'm happy to report that company JEPIL received its highest ever order intake in the current financial year from continuing operations since the financial year 2019-2020. Please refer to the presentation on our website or stock exchange for the further details. Your company is supported by a healthy backlog of about 2 years now, with the order intake of more than 2 times due to the continued operations as compared to the previous years. I would specifically like to call out our team's efforts in the geographical expansions. We have received orders from 5 countries so far: Saudi, Turkey, Australia, UAE, and Malaysia, intervention to about 6 gigawatts of the installed base. With the renewed operational rigor and the sharper focus on the financial discipline, we are entering the new financial year with confidence and purpose. With our product offerings in the renovation and modernization of steam turbines, we have supported our customers for reduction of about 0.8 mmp per year of carbon dioxide by increasing the efficiency of their assets by 5.5%. Further, our DNOx offerings will support the customer with a total saving of about 6,000 metric tons per year of NOx upon completion of the projects. Thank you for your patience, and now I will hand it over to Ashish, who will share the financial updates with you. Over to Ashish.
Thank you, Puneet. Good evening, everyone. Thank you for joining the earnings call today, first of all. And I would like to add the data points to the commercial update, which Puneet has shared, following by the financial performance of the company. During the current quarter, your company got orders worth 285 crore rupees compared to 232 crores in the corresponding period of last year. This marks a 22% increase quarter over quarter from the preceding period. And for the complete financial year, we have booked orders worth 2183 crores, like Puneet just mentioned, vis-a-vis 1171 crores in the previous year. This is almost a 2x growth year over year that we have seen. And Puneet also mentioned that this is highest since 1920. So I think that goes back to the commercial team and teams who have worked on it. Amongst the orders booked in the year, the key ones are FGD orders, which we booked from JP and Nidhi, Vindhyachal steam turbine upgrade from NTPC, and Banakpuri steam turbine upgrade from Gujarat State Electricity Corporation Limited. We also booked orders worth 548 crores in core services, pillar of our four-pillar strategy in 24-25 versus 501 crores last year. These orders provide a sustainable runway for future revenues. As at March 31st, 2025, your company, like Puneet has mentioned, has an order backlog of 2662 crores. So roughly 2,700 crores worth of order backlog, which stood at 1,587 crores as of March 31st, 2024. So your company is tending towards a growing and healthy backlog with better margins. Coming to the financials, we are seeing a steady and favorable shift in the sales mix, where we continue to progress on execution of FGD EPC contracts and convert it into sales, while the high-calorie businesses like core services are increasing. In the current quarter, we reported revenue of 266 crores, which is an 8% increase compared to 247 crores in the corresponding period of last year. Revenue for the financial year 24-25 sustained at 1047 crores versus 1039 crores in the previous year. However, important to note that the mix is moving towards the services business, with around 2/3 of the sales coming from it. We also saw strong focus on execution and profitability with better margin, better portfolio mix, and focused efforts resulting in operational performance of the company. The minority shareholders supported with the approval towards slump sale of hydro and gas business undertaking. And as a result, like we estimated and we informed, your company was successful in completing these transactions. We completed the hydro business transfer, resulting in a gain of 219 crores in the P&L as on March 31st, 2025. We also completed the gas business undertaking slump sale on 30th September 2024, earlier in the current year. Profit before tax for the quarter stood at 189 crores positive against a profit of 23 crores in the same period of last year. The exceptional gain from the closure of the hydro business undertaking transaction amounted to 219 crores as mentioned above. And when I compared the profit before tax for the full year, it stood at 224 crores in the year against a loss of 177 crores. The exceptional gain from slump sale of hydro and gas business amounted to rupees 262 crores in the current year. I'm also happy to share that your company on their cash performance has a surplus net cash position of 433 crores in the balance sheet of March 31st, 2025, and we are in that investment position. Before I open the forum for Q&A, I want to emphasize again that your company is on track on the strategy announced in the beginning of the current year and has consistently conveyed that this is a long-term transformation to sustain a healthy top line, profitable and cash surplus business. And we are going strong on it one quarter at a time. We are now open for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take our first question from the line of Lavish from Sushil Finance. Please go ahead.
Hi, I think it has been around 15 quarters our company has not performed well. And the conditions in India, I think, are very nice as compared to other power companies. So where are we lacking? Can you throw some light on it?
Thanks, Lavish, for this question. I think My response to your question would be that we are going very strong with respect to the strategy which we have already decided at the start of the year, wherein the four-pillar strategy was discussed and shared with all of you. We are very strong on the core services. You have seen the results that we have grown by about two times. One area wherein a little bit of a confusion was there at one point of the time over the financial year, wherein some news was there with respect to the FGD. Now that those clouds are also cleared, and the information which has been passed on from the Ministry of Environment and Forest is that the FGDs are going to stay, which is one of the third pillars of our strategy. So there was a bit of a slowness, a bit of the shift in the tendering, etc. We are moving strong on that also, because now the clouds and the policy decisions have been made quite clear moving ahead. And we have also been declared L1 in one of the FGD projects, which is FGD. So that brings the confidence back to us on the FGD pillar itself.
And also, if you can throw any light that the parent company, GE Vernova, will infuse some money or...
So, Lovish, we are a legal entity and we would like to speak only on our behalf. So maybe I'll answer it this way only.
Maybe I can add, Puneet. So, Lovish, you see, I mentioned a couple of data points and I'll repeat it. The net worth of your company as on 31st March 2025 stands at 233 crores positive. The cash position of your company stands at 433 crores positive. So if you look at the balance sheet post carve out of hydro and gas, I think it is a much stronger balance sheet from what we were in years before. And also, of course, it is backed by the operational and the commercial performance of the year. So at this point of time, JPL is moving forward with the strategy that we have announced, and we would continue to build on that and stay with us out there. So that is the position right now. I think the balance sheet supports what we are doing, and we would continue to give our 100% on that.
But as a shareholder, we all want that balance sheet reflects in stock price. So
we can't really comment on the stock price. We don't control that. Yeah, but we totally take your point. As a shareholder, you would want that capital appreciation for sure.
Yes. Thank you. That's all.
Thank you. Before we take the next question, would like to remind participants to press star and 1 to ask a question. Next question is from the line of Rahul Kapoor from Goldstone Capital. Please go ahead.
Yeah. Good afternoon, everyone. My question, the first question is with regards to the Q4 performance and, gross margins are just about 23%, which obviously has resulted in a negative EBITDA. Can you throw some light on why the, gross margins are as low as 23%, and can we expect better gross margins in the quarters ahead? Hello?
Yeah, I can answer that. Rahul, thanks for asking that question. So quarter 4 particularly, we have seen some prolongations and provisions on the FGD EPC sites which are ongoing, which we have baked in this quarter. So that is one of the key reasons for what you see. What we have also been actually able to do in the first 9 months of the year is also collect a lot of claims on account of either the fire insurance which happened earlier or price variation clause, which we have not seen in this particular quarter. So you would also see, if you look at the other income particular row from the financials, so it has been the lowest in the year. So we don't have that recovery of the losses that we have done, but just the booking of the regular prolongation provision in the quarter. So that is one thing which is putting the quarter under pressure by around 30 CR. So that's why you see a 30 CR negative profit from continuing operation before exceptional items. To your point on, shall we be seeing better margins or better operational margins going forward? Again, we do not, or we refrain from providing any projections or futuristic statements. However, what I would assure you is that what we have seen in this year is that our top line, there is a good portfolio mix change towards services. Our top line has seen 20% change from the historical new build FGD EPC project to the services project. So we are seeing that change already. And with the commercial performance that we have delivered in this year, we should see more of sales coming from the new strategy, which is the 4 pillar and majorly backed by core and upgrades. So we should see more of the top line coming from there, and those are our high calorie business, right? So I would stop it there, but I would not be able to give you any particular response on the futuristic markets.
I see. But I'm sure, while bidding for a new project, there was some kind of gross margins you would be looking at while bidding for a new project. Any idea, any ballpark figure as what kind of gross margins generally you look at while bidding for a new project?
Are you able to hear me? Sorry.
Yes, sorry. Were you able to hear me?
Yes. No, I heard your question. So this is Ashish again. Yes, I hear you. Again, I think that first is not a standard, margin. We also standard margin on a policy. It is deal by deal. Where we see strategic advantage, we are open to even go, for example, take a market entry. So all those strategic deals, we are more flexible, I would say, in terms of margins versus our OEM own machines where we service. We are not, we are very aggressive there in terms of pricing versus the OEM. So it is very different in all 4 pillars, and even within the pillar, it is very different depending on what kind of deal it is. So there is no standard answer to that. But what I can share with you is that our backlog, which I mentioned, of 2,662 crores as on 31st March 2025, it is a healthier backlog, and we have improved by 200 basis points. In fact, 200 basis points from where we started the year. We started the year at a 1,587 crores of order backlog, and we are anyways closing it at 2,662, which is a lot higher. So we are growing, and this growth in backlog has come along with 200 basis points of improved margin on that backlog. So that information, just to assure or to give you some confidence, I will share, if that helps you, Rahul.
Okay. My next question is about your Durgapur facility. Any color on the utilization levels, and can we expect some better utilization there? And if not, then what's the plans ahead for that facility?
Yeah, fair point, fair concern. We share that concern as well. So, and we have been almost every quarter we get that update. So last 2 quarters, we have said around 160 to 165,000 hours of utilization is what we expect of Durgapur delivering in 24-25. We have closed the year at 165. So the utilization for the current year is as per the plan, which was 165,000, and our capacity was around 242,000. So 2/3 we can say is what we have been able to utilize in this year. Now, having said that, of course, it is one-third underutilized. It's a fact, and it puts pressure on the P&L. So that's a fact. And the fourth pillar which we introduced, which is the Durgapur kind of growth, where we are focusing on the non-fossil, meaning pressure vessel and cryogenic, plus the exports from India, where the products would be it would be mid-steel, some bought out, but the products will be manufactured out of Durgapur. So we are only focusing on boiler and mills when we go out of India. So that was in attempt of actually not just feeding the factory, but feeding the factory with some very handsome profitable deals. So that was the endeavor with which we launched that fourth pillar, which did not exist any year back, right? So we have booked 18 crores worth of orders in that pillar in financial year 24-25, and we see a strong pipeline for that. However, having said that, the underutilization issues for Durgapur is not gonna go away in a year or a quarter. So that remains to be seen. That how best do we utilize that factory. So that is something we are trying to solve as well as we enter into 25-26.
Okay. Rahul, just to add what Ashish has said, it's a journey. It will take over a few quarters to get over it, and as we move forward, we have seen that there is a more or less like 7% of the order increase, at least from the Durgapur perspective. So we are inching towards it, but yes, I will echo what Ashish has said. It's a journey.
Okay. Thank you. Thanks.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take our next question from the line of Venkatraman, a retail investor. Please go ahead.
Good evening, sir.
Good evening, Venkat.
Hello. Yeah. Sir, just I want to know, because through curiosity, is there any possibility we'll change our name G for India Limited into G Vernova, like that? The other company, G Vernova Transmission Distribution, like that. Any chances there?
So we already have a differentiator, Venkati, G Power. I think the name change and all, of course, it doesn't happen in normally or every year. With Vernova getting, I would say, launched on day one, which was 2nd April 2024, they have changed what they had to, so there are no plans as of now for any change.
Okay, sir. Sir, now our company is debt-free company, right? Debt-free.
Yes, your company is debt-free company. Yes. In fact, I'm happy to share that as on 31st March 2025, we were in net investment position. We had invested in a nationalized bank with a FD of rupees 264 crores. So it is in net cash surplus and investment position.
Yeah, thanks a lot for your entire G Power team, sir, to achieve these things, sir. And I hope I'm expecting very good results in future, sir. Thank you.
Thank you, Venkatji. We are working with full endeavor for that.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. As there are no further questions, I now hand the conference over to Mr. Puneet Batla for closing comments. Over to you, sir.
Thank you, everybody. Thank you for your patience and thank you for your questions, and thanks to Ashish for supporting me on all these questions. So, investors, as we have said earlier also, it's a journey which we have undertaken for the last 6 months from July 24 onwards, wherein we are changing our strategy and we are getting towards the high calorie business. We have started seeing the results. We are inching towards that with stronger results. We would continue to move on to our strategy as we have decided so far and shared with you. Thanks for all your time. Thank you. Good evening.
Thank you. On behalf of GE Power India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.